Thank you all for taking out time to attend this session. Welcome to a session by the Finance Club on Mind Your Money with Mr. Jai Shah. Jai is an ISB alum and has a rich experience of 15 years in the Indian capital markets, spanning across investments, trading, arbitrage, and derivatives. In his last profile, he was a fund manager at Edelweiss Alpha Fund and managed close to rupees 2,000 crore of assets under management. He has also founded pmscart.com, which is India's largest database for portfolio management service information. He also runs his boutique wealth management firm, One Tree Hill, based out of Mumbai. Before I invite Jai, a couple of points. Please keep your audio and video muted throughout the call. We will have a question and answer session towards the end. We will first address a couple of questions that we received in advance from you all, followed by some questions which you may ask at any point of time in the chat window. Please unmute yourselves when we call out your name and request you please not to ask any portfolio or stock specific questions. Thank you. Over to you, Jai.
Thanks, Amanjeet. Hopefully my voice is as clear as yours.
Yes, it is. Absolutely.
Okay, perfect. So, just wanted to invite everyone once again from Amanjeet and, the ISB and the Finance Club side. And, thank you to Amanjeet and Punjan and everyone else from the team for having me, give this talk on Mind Your Money. Right? Basically, it's a, in the world that we live in right now, and before we get started, is I think one of the most aspects that is missed out by the majority of the people, including financial professionals, is personal finance, right? So this is basically an idea to take you all through what I believe are some of the missteps people take, some of the things people should do, some of the things people should be aware, and then take it from there. And as Amanjeet said, there are a few questions. I think we have enough time to take that questions at the end as well, and we'll do that, right? So if I can get started. Yes, okay. Perfect. So Amanjeet has just given a brief about myself. Just to run you through, I ran one of India's largest hedge funds called the Edelweiss Alpha Fund. 16 years of experience, 40 under 40 by an institution called AIWMI. Obviously a PGPM from ISB Hyderabad. Writing on various platforms, panelists, which is there. Run my wealth management from One Tree Hill, and also founded pmscart.com. But all this we can talk about later as well. So let's get dive into the interesting stuff. Just one thing. So there are a few sections which are I try to make it as interactive as possible, as much as these Zoom webinars allow. So at some point I will be asking questions. Amanjeet, is our chat on?
Yes, it is.
Okay, super, perfect. Right. So these are the basic learnings that I've come through in the last decade and a half. Right, where first one is markets do not repeat themselves, but they do rhyme. Right. Where everyone tries to put in a situation and compare it to history, which is great, but more often than not, that situation which is right now, right here, is a bit different but similar. So it's very important to understand that maybe what worked in the history might not work now, and maybe we need to do something else. People talk about diversification is the only free lunch. I mentioned optimal diversification, right? Because, this is a very important part of asset allocation as well. And we'll come to this point afterwards as well. The investor's chief problem is likely to be himself. All of us have itchy fingers when, things start to go wrong. We start to panic. Based on our original thesis, we'll try and change that on the fly. And that is where most of the problems in personal finance come across. Wealth is multiplied through a structured blueprint investing, right? Now, more often than not, we always have colleagues, friends, family, relatives who always been a part of the market, and there's a good amount of noise that comes from there, right? Why don't you buy this stock? Why don't you buy this mutual fund, etc.? But without any structure. So the entire idea of when sort of trying to figure out personal finance is structure, and everything is around that. One of the other things is determine your edge, right? It's easy to say that, look, I want to try and make more money than the market or the benchmark. But I think it's important to take 3 steps back and realize why you will be able to make that. If you can't figure out that answer, that why you will be able to make that, then I think you might as well just get into index fund, which might not be a bad strategy for you, right? Pundits on a CNBC or a ET now maybe don't have your financial future in mind, right? They don't know your liquidity need. They don't know what your expectations are. They don't know what your profile is. It's very easy to come and say, look, buy this stock at this point, stop loss this, target this, and then that's the end of the game for them. But for you, it might be very different. And last one is my favorite, which is this time is not different, right? Every time, according to me, is different, where we are saying that, look, what has worked in the past might not work right now. And hence, you need to be aware as to what you are doing, how you are doing, when you are doing, and then take it from there. What has changed in the last 5-6 years is that while a lot of people have invested through maybe mutual funds, or some of us consider insurance as investing as well, there has been a wide spectrum of different products that have come into the market, right? And in what we call alts or alternates, right? And this is somewhat of a chart which sort of specifies each alternate product that is there in the market available to anyone who has, obviously there are certain limits at certain different points in time, but there are different products now to actually diversify your risk and return, right? So we have the humble mutual fund, which most of us would know about. You have the PMS, which is more of a slice and dice mutual fund. You can get a better return at a much lower risk. You can get a much higher return at the same risk of a benchmark. You can get cash management. You can get a debt portfolio within that, and get a concentrated portfolio within a PMS. So quite different from a mutual fund. A structured product is more tuned towards the more nuanced investor who understands that, look, maybe I can convert the debt risk into an equity risk. So very simply, let's say if I have to give an example of a structured product which is available in the market right now, is I come and tell you that, look, for every 10% move or every percentage move in the benchmark on the upside, I will give you 1.5 times that, right? So let's say if Nifty is a benchmark, Nifty moves 10%, I'll give you 15%. And the best part is I'll say, look, your capital will be guaranteed, right? So if the Nifty comes down by even 50%, you will still get your money back. Now, obviously, this product, from what I've said, is too good to be true. There are risks such as liquidity. So this product doesn't give any liquidity to you. Plus, the person who's guaranteeing the product is effectively your counterparty risk. This is not guaranteed by the government of India or yours truly, right? It is, let's say it might be a Citibank, it might be an Edelweiss, it might be Anand Rathi, right? So you are dependent on them for when your product matures, that they have the ability to give you back. Of course, these products are registered on the exchange under SEBI, approved by SEBI, etc. So it's not a hand-me-down note saying that, look, we'll talk again after 3 years. The AIF and hedge fund has been a more recent innovation in our markets, at least, where we now have the ability to try and benefit from when the markets go down, right? Earlier, mutual funds, PMSs, etc., would only let you play on the long side, right? Saying that, look, we always have to be invested, but tomorrow if the markets go down, how do you actually benefit? So in AIFs and hedge funds, there is an ability to lever, an ability to short and go much more than the money given because of the lever, and try and do a whole host of things which either a mutual fund or a PMS cannot do right now, right? Then you have PE and VC funds. Now, these are obviously products which have not been available, and you had to become an LP to sort of participate into these. But now these have also come in the AIF structure, where it's much easier for a lot many HNIs, UHNIs to participate through a SEBI registered structure, right? And we have, I know, a couple of questions regarding this, but at the end of the day, you want a structure managed by somebody to be able to make you money, right? That is always the end goal, right? We come to unlisted shares. Unlisted shares have again become popular in the last 2-3 years, or what we call pre-IPO shares. where we can actually trade or buy shares of a company before they go IPO and onto the exchange. Now, this market, obviously, by its very nature, because it's unlisted, it's not very liquid, right? But there are enough players out there, enough brokers out there who, let's say, if you want to buy an NSE share, the NSE India Exchange share, an HDB share, a Hero FinCorp share, where you think there's significant benefit to buy it before it goes IPO. Obviously, the risk is that it is illiquid, it might or might not list at a future date, but we are seeing a significant amount of interest in the unlisted space. Preference shares are typically not understood very well because while they are equity, they might give a fixed income sort of return because there is a cash flow which is attached to it. They are generally liquid, not very prevalent for most stocks. In fact, the only preference share that I can think of right now, which is worth its salt, is maybe a Z preference share, right? Obviously, Z is going through its own set of challenges as we speak. So it depends on which preference share that you want, and obviously see the parentage and the legacy of that preference share. Special status refers to a completely different set, which was earlier very institutionalized, but now it has come into almost the public domain, where how can I benefit in a close to risk-free manner from mergers, from rights issues, from open offers, from buybacks, without having a significant knowledge of the underlying company, right? And why this has become important in our ecosystem is simply because it provides an uncorrelated return compared to what the market is doing, either from equity or the debt side. The last, but definitely not the least, and which is why you see a little bit of the edge which is remaining of things which will continue to come in the future, is what we call distressed assets. Right? Distressed assets is very simple, where you try and buy a company which cannot service its loan, but maybe still has an operating revenue which is based on a good business, right? Or you can turn around a company as well and buy it for cents on the dollar. This is generally related, also available in different AIFs. But I would say you have to be very careful as to what you are doing and have to be a player to actually figure out what the risk return is. Because the way things are moving with, and even pre-COVID, there have been enough opportunities which have seemed great, but have not fructified. And obviously, on the other side, opportunities which did not seem great, but eventually reached a significant settlement. Alok Industries, Bhushan Steel, all these guys have made it, and whoever has bought their assets have made a good amount of money on an average. So this is effectively the world of alts. There are much more things which varied in degree of complexity as well. uh, but if you have any questions on each of these, we'll probably get back. It will be difficult to get into each of these while during the time of this presentation, right? Uh, so one of the things that people talk about a lot is asset allocation, right? And at least I think I've really got it down to the T, where you just need to think about 9 things, right? So I call it the three musketeers, right? And that is not a typo out there, but basically you need to have the 3 factor test, the 3 bucket mop, and the 3 point line, and each of them have 3 points which you should look at. And I'm pretty sure if you follow just these simple 9 points, 60-70% of your issues that you faced with previously asset allocating your portfolio or your wealth will go away, right? So if you had to take out the 3 factor test, uh, you know, if you have to be an investor in any geography, whether it's India, US, etc., you have to be an optimist for the longer run, right? I would really discourage someone who is a pessimist to try and take part in the India story, right? Because at every 6 months or 3 months now, something or the other is always going wrong, and that prevents you from actually benefiting from the India story, which I believe in the long run will drive.
Hey, Jai, the voice has become a little weak on your end.
Okay, is this better now?
Yes, much better.
Okay, I think I covered the mic by mistake. Okay, so you have to be an optimist to believe, an optimist and believe in the India story to actually benefit by investments in India, right? The second thing is obviously to make sure that the asset allocation that you have, and we'll talk some more on this as well, is rock solid, right at that point in time. More often than not, we've seen the asset allocation is where the issue comes from rather than the fund which has lost 30%, right? Because when markets are down, there's a good chance a lot of the funds are plus or minus and everything becomes correlated, right? At that point, the only fallback is that, look, have I given enough to debt, enough to equity, enough to metals, enough to currency, enough to international, to make sure that I could be as diversified as much as possible or as much as my risk profile allows for, right? And the third point is what we call the fund selection. Now, obviously, like your five fingers on your hand, each and every fund is very different. There are different styles, different managers, different investment teams, different communication, etc. It's very important to understand what you are buying and why you are buying it, right? And 95% of people that we talk to, right, the simplest way that they try and figure out a good fund is maybe go to a money control or a value research or a morning star, saying that, look, okay, I want a multi-cap fund, let me see which multi-cap fund on an average has done well within the 1 year, 3 year, 5 year time frame, and let me buy the first or second or third fund out of that, or buy all three, and assuming or expecting that those three funds will continue to be the top three funds going forward, right? According to us, that's actually performance is actually an outcome of 4 or 5 different things, and we have a complete slide on how to select a fund as well. Once you've got these three aspects out, uh, the simplest thing to do is to divide your wealth into three buckets, right? Safety, risk, and greed, right? Safety is in our mind a lot to do with psychology, right? It's very difficult. And you will probably talk to your fathers, and they have a certain belief, right? Whether it's real estate, whether it's gold, whether it's silver, whether it's FD, whether it's jewelry, whether it's cash under the the mattress, that psychological thing is something that has been built over your history, right? I'm almost 38 years old, and I still believe, okay, maybe safety is an FD, right? But for somebody else it might be a completely different asset, so you have to determine what that asset for you is, right? Then provide a certain allocation to it, saying that, look, even if the world collapses, right, this safety bucket, I am pretty sure, I am pretty convinced nothing will happen to this, because I either have the holding power or I understand this asset inside out, right? We've seen, in fact, for a lot many younger people, in the 25 to 30-year-old, uh, there is no safety bucket. They're saying that, yeah, we are 25, 30, we have close to 40, 50 years ahead of us, and we might as well take the risk now, because I definitely can't take it 20, 30 years later, right? And which is a fair assessment, but that changes over time. Before we come to risk, I'll go on to greed, right? Greed is something which works beautifully for most of us, right? Because any aspect that comes onto us, which triggers, the sort of the fires in our brain, saying that, look, buy this stock, this will double in 6 months. Buy this mutual fund, is the best mutual fund out there. Just buy this for three stocks and forget about it for the rest of your life. That is greed, right? Where there is no real conviction per se, except for the fact that you have faith in something which you don't understand, right? And this is something important where a lot of advisors will discourage you to try and stop trading on your own, try and stop managing wealth on your own. In fact, we take a very different approach and say that, look, you should have something where you are feeding that psychological need of greed. Because as soon as you suppress that, there's a good chance you'll keep questioning the person who's giving you advice because you are not acting on it, right? The second is what we call the risk, which is everything what we saw in our alternate piece, right? Now, depending on where your risk return profile is and what you want to participate, it always makes sense to first assess your profile and then try and figure out where you want the risk in which asset and what is the expected return out of it, which comes to the 3 point line. And if anyone's watching, anyone used to watch NBA, this the 3 point line is from there, right? Where there are, just think of a triangle which is filled at one end with expectations, at one end is reality, and the other end or the other edge or the other point is liquidity. Now, where most people try and miss out on is expectations are very far away from reality, right? Expectations is, look, I will never want to lose money because someone has told me over a 5 year period, Nifty has given a 15% return, right? And it becomes very important to understand and actually realize what the expectation is, match it to the reality on the ground, and then make sure that you optimize for liquidity. When I say optimize for liquidity, it's very simple in terms of I need to optimize for tomorrow, I need to optimize for a shorter term, I need to optimize for a medium term, and I need to optimize for a longer term, right? Because at every different points in time, you will see that you require a certain amount of money, whether it's a medical emergency, whether it's buying a fancy car, investing in a house, etc. Liquidity is a very important tool that you need to figure out at that point in time. Obviously, things will change, but it's very important to figure out. In fact, a lot of questions come that, Jay, it doesn't look like emergency funds honestly contribute to anything, and it's probably just a wastage of returns where I can just put it in somewhere, right? And obviously, COVID has told us things differently, where it's very important to make sure that that liquidity is met to a good degree. Expectations are around the actual reality on the ground, and once you get these 3 points into at one common point, that's fantastic. In fact, our entire job as advisors is to get these 3 points at one confluence, right? And if you do these three things across asset classes, across your wealth, I guarantee that you will have a well thought out, transparent, simple, sustainable blueprint that will make your wealth work and that will make your money work. Right? And so, sort of illustrate this, and this is probably now, I'll, everyone who has access to chat at least, if you all can play this game with me, right? So if I ask a simple question, right? Let's say we have a fair dice, and I ask you all to put in your entire net wealth on one number with astronomical odds, saying that, look, if your number comes for every rupee that you put in, you will get that multiplied by 1,000, right? Would you do it? Right, if you can just have some answers. Okay, right, so everyone is saying there's a good chance everyone will say no, right? Now I'm going to keep the odds the same, right? Can you treat your question, please? Okay, repeat your question. Okay, I'm saying there's a fair dice. If you had to put your entire net wealth onto one number with the odds which are saying that for every 1 rupee, I will multiply that by 1,000 if your number comes. So clearly the answer is no, right? Now here's the fun part. I'll keep the odds the same for every rupee, let's say, but some portion, right? So Puneet will come to that, right? Now I say break it down and say that, look, instead of your entire net wealth, let's say I only ask you to put 1% of your net wealth onto this. Will everybody play the game now? Perfect, right? It's simple, right? What have you done is a simple asset allocation, right? Where you are wanting to stay alive in the game at a risk which is comfortable to you. Mind you, the odds have not changed, right? The market is still the same, but the way you play it has completely changed basis on how you allocate your money to different asset classes. And the simple idea that I'm trying to just push here is that you have to make sure at no point during this game of wealth management do you get uncomfortable. Because as soon as you get uncomfortable, you're going to say, let's remove this money and this is not for me, right? Which is better to establish that base first and then get into the game, right? So spend an inordinate amount of time trying to figure out what your goals are, what your profiles are, what are the options which are available to you, and then take it from there, right? This is a very simple graph where does timing work, right? And this is literally the nirvana which a lot of people have tried. Personally, I have failed myself, saying that it's almost impossible. Or I've tried multiple different times. I know very smart people who've tried to time the market and get it right consistently. What this graph or what this table shows is the returns on each asset class for each every year for the last decade. So we have gold, mid caps, international stocks, small cap, credit fund, GSEC, small cap, etc. And it's very simple to see that there is no one place which says that one asset class does consistently well over time. And hence, if actually I try and time an asset class today, there is a good chance some other asset class will beat it going into the future or from a 1, 2, 3, 4, 5, 10 year perspective, right? Someone would say 2010, 2011 was great for gold, right? As clearly visible. But I would ask them to, put their eyesight to the last row. The next 3, 4 years were horrible for gold, right? So if you invested in 2011 based on momentum per se, it would not have worked. What would definitely work again is some sort of an asset allocation where you're consciously saying that at different points, different assets would work. They will make sure that the volatility is quite low in my portfolio or as low as can be. And based on that volatility, the expected return is what I'm trying to optimize. Once I establish that, look, I don't want my portfolio to go below 15% at any given point in time or wealth, right? It is very simple or it is easier to come to which asset classes you should invest in and with what asset allocation, right? So uh, this also answers the question which a lot of people had: is gold a good time to invest? Is it a good time to invest in gold right now, right? And clearly we've seen the last 10 years, and this can be taken back into history, there hasn't been one stretch across time where one asset class has done really well. Sure, you might find a string of 3, 4 years where different asset classes have done really well. And maybe the US is probably a good example right now where, they've been in a bull run for the last 4, 5 years where their equity has done really well. However, it is very important to make sure that you know what you have access to and what is the risk on that asset, right? And this again comes down to this graph where every time that you can hold, and this is with related to our equity markets, any asset that you can hold for a longer period of time, the volatility on that asset comes down significantly with respect to the return, right? So if I had to look at the first blue graph and the first yellow graph and the first orange graph, it tells me that if I hold Nifty for a year, historically, I've maybe made 100% return, which is my maximum return. But I've also lost close to 55, 60%, right? And both of these numbers sort of reduce over time. And then you'll see that at the end of maybe the 7th or the 8th year, the maximum that you can make compared to the minimum is significantly higher in terms of a ratio, which is the average by volatility, right? So as much as you can stretch time, the better the reward versus risk ratio comes in your favor. And if you only look at your portfolio, let's say every 7 years, or on a rolling 7-year period, you will notice that you don't have any negative years. And this actually ties back to why, somewhat to why, people who come on TV or advisors say, sir, aap 5 saal ke liye rakho, right? Because they also know that over 5 years, there's a very little chance that your portfolio will be negative, and they should be able to tide over that. But that's probably not the right way to look at it, obviously, right? A to B over 5 years, with things changing, jobs changing, COVID coming in, US China wars, it's very important that the journey itself be taken into account, right? This is one of the other questions that I have. Now, let's say you start on the left hand side at 100 rupees, right? Which one do you think, and let's say the end point is at the end of point number 11, which time series do you think is more volatile, right? Which appeals to you as being more volatile, right? Is it alpha, beta, or cheetah? And if you could sort of write your answers, that will be great. Okay, we have alpha, cheetah, beta, alpha, alpha, beta, right? Okay, let's just wait another 10-15 seconds. Okay, Sonia is asking, can I repeat the question? Absolutely. Let's assume this is a stock series or the graph of a stock, or maybe even your wealth, where the starting point and end point is the same. Which of these series is the most volatile according to you? Okay, so clearly if you guys are also watching the graph, it's very varied, right? I think a lot of people are stuck between alpha and beta, and very few people saying cheetah, but the answer quantitatively is that they have the same volatility, right? This is literally, if you realize, volatility per se is irrespective of the journey. It is only dependent on data points. So let's say if I have to say the beta portfolio is actually 10% minus 10%, 10% minus 10%, minus 10%, etc., alternating, right? The other two, alpha and cheetah, are just different variants of 10% and minus 10%, having the same number of up 10% and having the same number of minus 10%, right? What this tells you is that even if someone tells you point A to point B, for you, it is very important to understand how you are going to reach point A to point B. Are you comfortable taking the alpha path or the beta path or the cheetah path, right? Otherwise, and this is where most of the hurdles come in, that everyone sells the point to point story, but no one is interested in actually trying to make your journey comfortable, right? And there are multiple ways to reach from point A to point B, which makes you comfortable. Every time we talk to a client, they're saying that, look, Jai, we're coming in with an expectation of 15%, which is great, there's no issue in that. But even then, your entire portfolio is skewed towards maybe small caps, right? Then your direction or your journey might not what you think you might expect. And which again comes back to expectation, meeting reality, meeting liquidity. Because in my mind, a small cap fund generally tends to have a much higher time horizon that is needed to realize a certain return compared to maybe an index fund, right? On a good probability basis. And hence, psychologically, the important thing to understand is, while A to B is clear, how are you going to make that journey, and how are you going to enable that in a way that is you are comfortable with, right? Okay, so done. So strategies on current portfolios, right? Everyone has lost money right now in a market like this. Everyone is wondering what to do and how to go about it, as well as trying to figure out that, look, I don't want to be left out, right? So the first thing I suggest that you all should do an asset allocation review. Make a simple Excel sheet, get an advisor to help you if you're not don't have that capability, but just make a simple asset allocation saying that, look, this is the risk on this asset, this is the return, this is what I expect in 1 year, 2 years, 3 years, 5 years. Just ask yourself those questions, because honestly, there is no market bottom. The only bottom that is there is the lifestyle that you want to lead, right? And that is something that you don't want to reach. Under no circumstances do you want to say that, Jai, I want to take enough risk that my lifestyle comes into question, right? Nobody wants to go there. The market will continue to do something irrational for longer than you can. But however, your lifestyle, your asset allocation is completely under your control, right? Coming to over diversification, sometimes we find that a few client portfolios in the name of diversification have 7, 8, 9, 10 mutual funds, right? Guys, a mutual fund is made to be diversified. It has 50, 60 stocks, right? If you have 50, 60 stocks and 10 mutual funds, let's say the maximum that you can have is 500 stocks. Of course, there's some overlap, and let's say that overlap is around 30, 40%, right? Let's say 50%. That comes down to 250 stocks. Even at 250 stocks, no matter what anybody says, you are in effect the market. Because you are in effect the market, over a period of time, you will get market returns minus the fees that you're paying for your mutual funds. And hence, if you remember, diversification is not the free lunch, but optimal diversification is the only free lunch which is there, right? So make sure that you are reviewing your mutual funds, asking the right question, that why do I need 10 mutual funds? Why do I need these 10 products to make a particular return, right? Everyone cannot outperform the market. There is a good amount of bell curve in each and everything related to finance, right? So you have to ask yourself, where do you want to put your bets and why? The second question we can ask the lot, Jai, markets have fallen significantly. Why should I book my losses, or should I book my losses, right? See, we are saying that, look, this is a great time to get out of something which is not optimal. So if you had some stocks and you don't know why you got into them in the first place, that is the first thing you should get out of, right? Hope does not work. And I'm saying, once you've gotten out of that stock, maybe put it in a stock after doing some research, right? Saying that, look, I didn't know why I got in, but someone told me that X stock was great. I think these 10 reasons actually make sense compared to these 4 downsides that I can see. And hence just shift that exposure to something better, right? So tactically try and get out of losing positions which you probably don't understand why you are there, and shift them into something better, right? Book those losses. Believe me, that will improve your book, right? The third, and this doesn't change across times, but more important now, is FOMO, or fear of missing out, right? Uh, we had clients who missed on 2014, 2017, 2004, 2009, and this doesn't change across time, right? The idea is that, when are you confident to put in money with a higher amount? Whenever you come across the fear of missing out, you are in a mode of speculating, right? You're not thinking why you're saying that, look, let me just put in a certain amount. So in case the markets go up 10%, in case a vaccine comes out tomorrow, I want to make sure that I participate to a good degree, right? And I try and flip that question in saying that you can make a lot more money by putting significant amounts of money when you're confident, right? The probability of FOMO, or a trade that you've taken in FOMO, is much lesser compared to when you're confident with a significant amount of money. Sure, you might make the expected high return is lower, but there's a high probability you will make that. And hence, don't worry about FOMO. Just go back to your asset allocation and let that ride it for you, more than your mind riding your asset allocation, right? We get a lot of questions regarding fresh allocation, saying that, Jai, I'm lucky that I've had a lot of money which I've not invested. should I start investing today? Because everyone seems to be worried, but everyone seems to be saying that now is a great time because everything's on sale, right? When everything's on sale, especially in the finance market, it doesn't have a definite timeline saying that the sale ends end of May, right? It might go on for 6 months, it might go on for 12 months. So always keep the door for optionality. Don't, and which comes to the next point, don't try and chase returns, right? Because any increased return always, without any doubt, means increased risk, which will always mean you will have itchy fingers saying that I don't know why I did this, let me change this to this because someone said X, Y, and Z. Now Amanjit is saying this, now Jai is saying this today. Always never chase returns, always chase an asset allocation, making sure that you have enough option, making sure that you're confident in what you're doing, and trying to make sure that, look, if I need to book some losses today and shift to better assets, there is no good time than when these losses are, right? So these are strategies on the current portfolio that you can do. Some of the more immediate rectification steps, and these are some of the pitfalls that we've seen happen in our markets. Shift from large caps, right? Now, large caps, and I've forgotten a word, but large cap mutual funds, right? A large cap mutual fund right now has to put in 85% in the top 100 stocks. By that very definition, they become very close to the benchmark. Now, if they're very close to the benchmark, there is a good chance over a period of time you will get plus or minus benchmark returns, but you'll end up paying the fees for the mutual fund, which is, let's say, if you have gone through an advisor, is 2%. So you will actually always make, going forward from year or year and a half, almost always make returns that are lower than your benchmark, and would lead to asking you that, why did I put in large caps, or why are these funds not performing as they should? And hence shift your exposure from large cap mutual funds to index funds or multi-cap funds, right? Index funds are generally low cost funds. Multi-cap funds have that flexibility to try and make that alpha. Generally, they tend to be at least 40-50% in large caps, and then try and vary that exposure in mid caps, and hence try and provide that alpha, right? We then come down to concentrate equity and diversify debt, right? When you are trying to, and this comes back to the question of diversification across mutual funds, right? If I'm trying to make money out of equity, I don't want 200, 300 stocks in my portfolio. I want ideally maybe 30, 40 stocks, which have done my research and truly believe in a particular asset class or a market cap segment, right? So try and concentrate your equity in a manner that you leave the potential to generate alpha, right? Uh, Diversify debt. I think this is fairly simple. And when we did this presentation around 6-7 days before the Franklin Templeton thing happened, and this is exactly one of the reasons why you should diversify debt, is that debt is something where you want safety and consistent returns. You don't want to chase returns in a debt fund. That doesn't make sense. Chase returns in an equity fund. Take that risk in equity. Debt is almost always you're trying to do it as an alternate to a safer asset, maybe an FD in this case, right? So don't try and make 5-6% more than an FD. Leave that job to your equity portfolio more than anything else, right? Optimize for cost. What we've seen is, in the name of balanced and hybrid funds, in mutual funds particularly, it's a great sell, right? Saying that, sir, आपका जब equity is doing well, आपका equity portion अच्छा करेगा. जब markets नीचे आ रहे हैं, आपका debt portion अच्छा करेगा, right? That is the general sell which people buy a balanced and hybrid fund with. But people should ask, what is the expense for that balanced fund? Now, from an AMC side, they're definitely trying to do more work for you. But you could, you could sort of just break it down into parts, saying that, look, if I have 100 rupees, instead of buying an expensive balanced fund, I should just put 65 in equity and 35 in debt, and get that, and maybe save close to, on an average, we've seen that between, if you break it down into parts, you can save close to 30% of costs, right? Doing exactly the same thing. And there are other issues with balanced funds as well. In that is generally a product which is not looked at very closely, right? The equity portion comes from the equity funds, the debt portion comes from the debt fund. There's no one who's talking in between. We don't know whether it's going to be a multi-cap fund in the equity side, a large cap, a small cap, a mid cap, because there is no rule surrounding this per se. It's just that 65% has to be in equity, 35% has to be in debt, and hence you can get the equity portion. But try and assess the fees, why you are in a balanced fund, and if you can get out and say that, look, I like HDFC equity and Kotak debt. So let me put 65 rupees in HDFC equity and maybe 35 in Kotak debt. You're just, in these small changes, will improve your portfolio tremendously. Right? We already talked about this, which is to determine your fixed income objective. Now, again, we've seen that people go back to a money control, a value research, saying that Franklin funds have done well, and they did for a good amount of time, but it was because of a higher risk that they were taking, right? You have to determine your fixed income objectives. Is it safety and consistency? And I can say with a very good degree of confidence that 99% of the people out here will say that it is always safety and consistency and nothing more. Nowhere will you mention that a higher return is required. Sure, everyone wants a higher return, there's no doubt about that, but at what cost? And historical returns, more so for debt funds, have a very small part to play on how it will do in the future, right? Almost always the current interest rates will determine what the future rates will be. That's why you have that YTM, which you should look at rather than past performance, right? The YTM, or yield to maturity, is effectively the yield that you will make and not your past returns. In fact, that YTM is looking into the future and telling you that is going to be your return, which hopefully you can look at the portfolio, determine it to be safe, and say that, look, this does not have a higher maturity, and hence will be less sensitive to interest rates, and hence let me go into something which is maybe low duration, high safety, which will give me consistent and safe returns. Also, now we have the ability to diversify a good amount of risk, right, across asset classes, right? Be it currency, be it international funds, be it commodities. You can try and diversify, and very simply, either through your broker, your advisor, mutual funds, these are all structures. But try and diversify holistically rather than just between mutual funds, right? It has become very critical in the day and age that we live, that over a long period of time, diversification is the one which is going to reduce the volatility. Obviously, there will be times like the one we have faced maybe in March and April, where almost each asset or each asset class behaved in the same manner, where we said that, look, everything is falling, whether you are in gold, international funds, currency, equities, debt, they were all correlated, right? So how do you actually pick a good fund outside of performance, right? And maybe we can get some answers if some people have out here, right? How do you guys pick a good fund? And performance is not an answer. Anyone on the chat? Fund manager, gut feel, excellent to know. Performance of fund manager, low cost. Look at holdings of the scheme, risk adjusted return, that's performance. Fund manager, news, okay. Fund family, okay. Process followed to select assets, excellent. Sharp Sortino related to performance. AUM, okay. Fund manager again, diversified, low expenses. Ask Jai, that's a good answer. portfolio, AUM, cost, follow recommendation of money manager. Okay, fair enough. Composition of stocks. Okay, so this is how I would look at, or how we look at. Some of them got covered, but let me try and explain what I mean. Right. One is track record. Right. So how long has someone been doing the same thing that they have been doing? Right. Is it a new sort of new star fund manager who had a great 1 year? I would avoid those, or maybe give a small allocation. The probability of making money is higher when someone has been consistently doing something good and not related to performance, but following the same philosophy across a period of time, but open to change as well. Right? So the track record of that particular fund, not with performance per se, but more historically in terms of what their philosophy has been. Coming to the investment team, right? I'm guessing almost everyone has worked in a team, and you'll realize that the assignment of work is literally 20-80 or 80-20, right? Where 20% of, let's call it, the CIO or the investment manager is taking 80% of the calls, but 80% of the work at the beginning is done by the investment team or the analyst or the senior analyst. Now, these is what I would call the workhorses uh, of the funds, right? These are the guys who are going to those factories, going to those conferences and getting that information back, analyzing it, and pushing it forward maybe to the fund manager and the CIO, right? And then you have to see how much of a churn has been there in this investment team, right? At least the funds that we like, there's been very little churn in the investment team itself, right? So which tells me these guys are getting paid well, they like what they are doing, and they're happy to make sure that they are growing with the organization and that they see a possibility of growing along with the organization, right? Coming to distractions and focus. Now, if I told you that someone has to look at in a business, operations, marketing, investing, logistics, etc., right? Would you give that person any money? You're saying that, look, you have too many distractions. So many times we've seen the same fund manager looking at large cap funds, mid cap funds, small cap funds, multi cap funds, multi manager funds, etc., right? It's just too much of a distraction. And then what happens is that almost all the funds become one sort of one giant fund, right? Either because of AUM, which is less, he might not concentrate on something and think that, look, this fund is doing well now. Let me try and sell a story here, right? So try and get into fund managers or invest with fund managers who have very few distractions, right? Communication frequency, right? And I give a very simple example. How many of y'all have heard from Bank of Baroda? Right? Bank of Baroda has an AMC. And I don't need to ask you guys in chat out there. I'm pretty sure less than 1%, if at all, right? Now, the idea is to make sure that your thesis or your the reason to invest in a particular fund is driven by a particular thought or philosophy. Now, things might go right or might go wrong. It could go either which way. But the most important thing for us is that, is the fund manager or is the AMC actually bothered in communicating with what they are doing, what is going right, what is going wrong, right? And one of the things which has separated a lot of people during this virus time is that some people have gone into hyper communication, right? They're saying that, look, this is what we are doing, this is why we are doing it, this is why you will make money. Now, you can agree or disagree with that, and that's absolutely okay, but you should be able to at least be able to make that judgment, right? If someone has gone into a black box, you have no clue as to what is happening, that's much worse off than trying to be able to make a very legitimate decision based on information, right? And then what happens is that your advisor will try and spin a story around that where he has no clue because he has no answer from the fund manager or the AMC. And maybe a year, 2 years down the line, you'll realize that, look, he spun a story and, I believed him. right? Then comes down to sort of style and organization, right? Which we talked about. Is the AMC, the CIO, the fund manager, the investment team, are they all on the same page, right? How many management changes have gone through? Good, bad, ugly, we'll come to know maybe 3-4 years later, right? So let's say if I had to say, one of the AMCs has recently undergone a significant management change. And if you talk to anyone out there, it's very clear that there is very little communication as to what the management wants, because they are trying to formulate a strategy, what the goals of the AMC should be, and what the fund manager is trying to do, because all of them are talking different things. And hence, even though maybe in a year they might have done well, you might not want to give them your money, right? And the last comes to performance matrix, and you can have multiple factors out here. I encourage everyone to look at multiple factors. Look at drawdown, look at volatility, look at Sharp, look at Sortino, look at Calmer, rather than just going to a money control or a value research and trying to sort it out by the best funds which have done well in the 1, 3, and 5 year bracket. In fact, there's enough academic information out there which says most mutual funds in the first quartile tend to go to the third and fourth quartile, but most mutual funds that remain in the second quartile remain in the second quartile, right? And the objective always with any product should be twofold, right? One, it should do better than your benchmark, and second, it should try and beat your peers. According to me, and I'm happy to discuss this more, trying to buy or expect a particular fund to consistently be in the top tier is a very difficult game to play and fraught with risk, right? So that's with respect to a fund. Okay, so how do you evaluate a advisor then, right? If someone can throw up a few answers, how would you guys pick to your advisor? Have you guys picked your advisor? Fees, okay? Reputation, excellent. Track record, amount of wealth he manages, avoid jargon, honest in communication. ET money is the advisor, okay? Reference, excellent. Word of mouth, known people, trust. Okay, so again, a very simple answer, knowledge, right? And I think more or less, if I have to break down what you guys said, it comes down to one word, which is crest, right? First, what is the credibility of that person, right? Most of us talk to banks, they get us RMs, right? Sir, ye le lo, ye le lo. What is the credibility that he or she brings to the table, right? Is there something that he or she has done in their past? Is there something in the public knowledge which is available, which I can check that, look, he has done something, as someone said that, look, he's come through a reference and is very good. And assuming that person has not been just being advised for the last 3 months, but over a period of time, that is what credibility is. That is the first thing you should establish before talking to anyone, right? Second thing is recognition, right? Is there any place, and not internal, I'm not trying to diminish the internal awards that keep getting thrown around within an organization. This guy is employee of the month, this guy is advisor of the month, but actually, is there some external source which has given them some recognition, and that adds to the credibility, right? The third thing is experience. Has he been around for enough time to have actually seen different markets, different asset classes, different cycles in the markets, and say that, look, he's also gone through his shit to manage your money. And in fact, one of the jokes with my clients is that, Jai, look, I'm not hiring you because you've made money or you will make money with a magic wand. I just want you to not make the same mistakes for me that you've made in the last 15, 16 years of your experience, right? And he says that that itself will make me more money, right? Because I've eliminated a lot of mistakes. I know there's a good chance you will not make those mistakes, and hence establish that experience, right? Is it credible? Has he been doing it is he or she been doing it for a good amount of time? Someone did mention success. what is the proof of success? Right? I can go around telling anyone that, look, I have 100 clients, I'm managing 100 crores, all of them are positive. But is there any actual method to verify that? Right? Has he done something in the public domain? Has he come across a client who matched with a similar profile to yours and said that, look, yes, he has made me money over time and knows what he's talking about, right? So can you establish his success before giving him or her your money? And the last one is transparent, right? In this particular market, it's very difficult to appear transparent, right? Because people don't want to share information. More likely they don't understand debt funds or arbitrage funds or equity funds and what are the interconnections, etc. Second, they're very opaque with fees. As someone mentioned, fees are a very important part of this entire bucket. You have to be transparent. If you think that person is not being transparent, he's being cagey, then there's a good chance maybe he's not hiding anything right now, but maybe in the future he's going to spin a few stories and it's not going to be worth your while to be invested through that person, right? So that is, just remember, Crest and anyone you're talking to, just apply these 5 things and any other thing that you have and you should be golden, right? So I think I'm at the end of my presentation. uh, I think we have, well, excellent, an hour, super, almost on time. Amanjit, I'm happy to
Yeah,
take on
we have
questions.
about 30-35 minutes, I think, for questions. So
Super.
thanks a lot for that, Jay. I think we'll get started on the questions. So, this question comes in the background as, for most of the salaried class, investments are typically, one is mutual funds and the second is what people do in ATC to get a tax reduction.
Sure.
Now, given the new tax regime, people actually have an option to go between the old tax regime and new tax regime.
Right.
And just for some background for other people, in the new tax regime, you don't have to make the investments, but you still get some amount of deduction, but you have to forego all the other deductions that you used to get, like HRA, etc.
Absolutely.
So what do you think is the better thing that we should do? Because now all the employers are asking, what do you want to do, and we'll deduct your TDS
Yeah.
accordingly.
Correct. So I think there's a simple answer to this. Uh, I think keeping that optionality of deductions itself has value, right? Almost always, a lot of companies are moving around. So, LTA, HRA, because you might be renting a house, etc. All those things become very important, right? And as you progress more and more, I think the sweet spot is that somewhere between 10 to 15 lakhs is, if that is your taxable income. Anything above that, you should stick to the old regime and take your deductions. Anything below that, you should come into the new regime. And with those, and obviously you can't take the deduction then, but then you try to save on time. So I think 10 to 15 lakhs is the number. If you ask me if you're clear on the deductions, then it's a simple mathematical equation, right? There should not be any doubt about it. But if I was in somebody's place who's between 10 to 15 lakhs, I would still go to the old regime and keep that optionality open for the deductions.
Sure. Thanks. The next question is, what is your view on PPF, that is Public Provident Fund? And what would be your advice on our generation? How should we treat it? Should we invest in, what should be the quantum?
So quantum is very simple. You're limited to 1.5 lakhs a year, right? Per PAN card, if I'm not mistaken. And the second part is, you can obviously, take that tax benefit as well. I believe it's the ATC, if I'm not mistaken, segment, which is there. But I think it's a great product, right? 7% that you're getting at sovereign risk, tax free, if you can, go past the 6-7 years that, it's locked in at. And effectively that turns out to be a 10%, 11% return pre-tax. So assuming you fall into a bracket which is the marginal taxation, you should definitely try and maximize the PF, EPF, etc. as much as possible.
Got it. We have the next question from Survi Solanke. Hi, Survi. Can you please unmute yourself?
Yeah, thanks, Aman. Thanks, Jay, for this insightful session. So my question is, what is your view on renting a house versus buying a house?
Sure. So Surbi, this is not a answer that can be made into a cookie cutter answer. It has to be related more to where you are, what you are doing, what you think your progression will be, and how then you will be able to make that extra return or put in that arbitrage. So as an example, the tier 2 cities generally have a much lower cost but a higher yield on rent, right? A city like Bombay has a much higher cost of houses but a much lower yield on rent, right? Now, depending on where you're buying a house, whether it's in tier 2, tier 1, tier 3, etc., these questions will obviously continuously change. Without a doubt, right now, again, I think it comes down to a mathematical equation where I think if you think, you have a fixed rate of an EMI that you might be taking compared to the house rent or yield that you might be paying, it comes down to that.
Right.
No
Right.
cookie cutter answer, unfortunately, should be that I can provide. Well,
Like, but yeah,
will,
but that does make sense, to have a mathematical equation to figure out what best works for you.
and one of the things that I've seen people do is they put in certain assumptions, right? So if you ask me, is it worth buying a house right now from an investment? Probably not, right? And then you say that, look, okay, if this is not going to grow over the next 5 years, should I rent it out for 5 years and then maybe once the real estate market starts to pick up, if at all it does, and when it does, maybe shift that to buying a house.
Right. Right. Okay. Thanks. Aman, can I ask one another
Sure.
question? Is that okay?
Yeah,
Yeah.
sure.
So my next question is, if we can, should we look at buying gold ETFs or sovereign gold bonds as an investment avenue?
Absolutely. So this comes down to asset allocation again, Survi. Uh, how much of your wealth you want to put into these assets, whether it's a sovereign gold bond paying you 2.5%, whether it's an ETF of which there's actual gold backing, or because gold is sort of small in compared to the value that you're paying. Some people just like to buy physical gold, right? It definitely should find some diversification just because of this graph, right? This one, right? Because gold, like any other asset, will have its ups and downs, but you would want to diversify because it actually truly provides diversification over a period of time.
Right.
Great.
Okay.
Yeah. Thanks. We have the next question from Saurabh. Saurabh, can you unmute yourself, please? Okay. His question was, at what age should I, start applying for life insurance? He's got medical insurance under 80D, but he doesn't have life insurance.
Okay, fair enough. So I think life insurance is extremely important. I have a different sort of, term insurance ties up more with what we are talking about, where again, this comes down to that wastage, right? Where every month, do I want to pay a certain amount to a life agent or a life insurance, in fact, where I am actually not going to see the benefit. And that is exactly the point. You're not paying for yourself. As soon as you have dependents, whether it is your aged parents, whether it is your spouse, whether it is for your kids, that is exactly when you should start using your term insurance or start investing or start buying your term insurance. And one of the simplest sort of back of the envelope calculation that we look at is to determine what is your monthly expenditure to lead a good lifestyle, right? If you divide or you multiply that by 70%, to put it bluntly, when you are probably not there, right? And then multiply that number by 12 is what the yearly return is, or the yearly number or yearly expenditure that you require. And that, if you divide by a risk-free rate, is the number that should be your life insurance or term insurance. Because if your dependents can then put that money in an FD, you know that every month they will get a certain amount. That certain amount is going to be enough for them to lead a certain lifestyle and hence taken care of.
Great. We have the next question from Ankit Avasti. Ankit, can you please unmute yourself? Okay, so his question was about mutual fund management. If you have a mutual fund that has not been performing well, should one stop SIP, pull out the money, or do anything else?
Absolutely. So first, I think it's very important to understand whether the allocation that you've meant for that particular mutual fund is right. Not doing well has multiple different implications, right? It's equity. It can lose money. So if Ankit is coming from that perspective that has lost money per se, I think that's incomplete information because markets will go down. It would be unfair for anybody to say that equity is not a risky product, right? At least from a shorter term where it can go negative from an entry point, right? If he tells me that, look, a mutual fund has outperformed or underperformed the benchmark from a 3-5 year perspective, then that is something definitely to look inside. Then what has been the reason for that underperformance, right? So saying very simply, Amanjin, that it has not done well is incomplete information, unfortunately. Should we stop SIPs from a more macro picture? My belief is timing is very difficult. So from just that understanding, SIP should always continue.
Got it. We have the next question from Mr. Girish Gandhi. Girish, can you please unmute yourself, please?
Thanks, Aman. Jay, thanks for the insights. There's been a recent trend regarding the AMCs wherein they have multiple fund managers managing the same fund. Generally, they have a mix of 2-3 fund managers where they have some experienced guys and some new guys also. So
Sure.
in that case, how do we keep a track of the when we say evaluating the fund based on the fund manager's track record? How do we evaluate the fund as per that?
So there are 2-3 ways to look at this, and this is more, Girish, this is more of a qualitative aspect than anything else, right? I'm saying if someone has been heading and leading and doing well in that particular job, one, the management is seeing that, look, this guy is fit for this, right? Second, because he's been there for a certain amount of time, the philosophy that fund has been established, right? So if tomorrow someone new has come, and this is easy to figure out from seeing fact sheets every month, right, which are generally available on the AMC website, right? So if let's assume there's an HDFC equity fund, you see the fund manager has changed. The first thing that you should establish or try and establish is that what is this person's credibility, and is he the same philosophy person as the previous fund managers? See, fund managers will change. It is the fact of life, right? It doesn't always mean that you have to get out of the fund, but always evaluate that what is this fund manager bringing to the table? Is he adding value, or is he subtracting value from what your initial thought of getting into the fund was? Very often, Girish, unfortunately, we get into a fund with very little information, right? Which doesn't unfortunately work over a long period of time, because at some point it will go through its cycle. When things are going great, our we as advisors have it fantastic. There are no client calls saying that, Jai, make me more money, right? But when things start to sort of go bad is when we get client calls saying, Jai, why are things going bad? At that point, whether even if you're doing direct mutual fund, it's very important to assess the edge that we talked about. Is that edge still prevalent? If the answer is yes, there is no need to change that mutual fund, that advisor, or anything else.
Great. We have a common question. I'll just take this. Paramveer Singh, can you please unmute yourself?
Yes, hi there. So just a quick question on NPS. I'm sure many of us have that query.
Sure.
Although it's a small contribution amount, but since it is there to avail, do you recommend that, or we park our funds elsewhere where probably
absolutely. See, you can park that 50,000 over and above the 1.5 lakhs, which is allowed under ATC, right? Should be done. If you think it's a significant amount for you, definitely go ahead and do it. If you think it's not worth it, I would not add a more complex wheel to save maybe that 10-15,000. is just one more thing to evaluate for very little value.
You answered. Good. Thank you.
So I think this answered a couple of other people as well. Next question is from Mr. Pratik Sharma. Pratik? Okay. So his question was, when you mentioned about selecting a fund, where do people like us get information or data on the criteria to select fund managers that you put on the slide?
On the fact sheet. See, so Amanjit, it's very simple. Nothing comes easy, right?
Right.
You have to follow a particular fund, right? If you, let's say for me, it's easy to call up the fund manager, relatively easy to call up the fund manager and get a certain amount of information, right? As you're saying, for the common man or someone like you, it might not be easy. But the fact sheet has a good amount of information in which most of those things will be answered. If not, most people also keep doing con calls, right? Where you can get a certain amount of information on that fund manager, on his philosophy, on the AMC. All these guys keep coming on TV. All these guys keep giving interviews. Unfortunately, someone has to sit through them and understand whether this matches with your philosophy or not. And it's very clear. I'll give you a very simple example. One of the bigger fund houses, right? Uh, they have a very distinct philosophy of investing in PSUs, right? And it's very hard-headed of sorts, at least according to me, right? It might be a great philosophy, might work from time to time, but for me, I'm looking for maybe a fund manager who's actively looking out for new information and not stuck on an old philosophy. So I don't want him obviously to go on the trading side where he's trying to come up with a new idea every 5 days, but maybe at least every 6 months, and try and work towards that rather than sticking to one philosophy which you aren't willing to change.
Got it. Got it. So we have a question from Hussein on your perspective on the new REITs, which is your real estate investment trusts.
Sure. So again, Hussein, the answer is unfortunately not simple. It requires a good view on the real estate market, and I'm assuming you're referring to the embassy REIT in this manner. If you think in some place like Bangalore, where embassy is doing well or has been doing well, where WeWork will continue to sort of rent out their properties, they will be able to manage them, etc. There will be a good amount of yield which will not stop, as well as capital appreciation, which is what the REIT is about in two parts. Then most definitely it should find a part of your allocation, right? But this should be an opinion which is backed by facts. It is very simple to say that, look, I'm diversifying in REITs as well. I'm diversifying in gold as well. I'm diversifying in A, B, and C. But why are you diversifying is extremely important.
Yep, thank you. We have a question from Shri. Shri, can you please unmute and ask?
Yeah, so basically, I just wanted to ask if you would advise a percentage allocation across asset classes such as shares, mutual fund, real estate, gold, etc. See, I understand it may vary as per the individual's risk appetite, but a generic percentage, if you can
Sure,
guide.
sure. So, Shri, I would say 80% of this market works on the 70-30 principle or 60-40 principle, right? 60% equities, 40% debt. I just find that being a more bottom up approach to this and then coming to those percentages is very important, right? So first is very important to understand why you want to do equities. Like, what is the benefit equities is giving at the end of the day, right? If my expectation is 15%, right, from point A to B, and I honestly, let's say there is a certain amount of money that I don't care about, right? Saying that, look, I got a good legacy, and I've got a lot of money through my hereditary, which I honestly don't care about. I would want to maximize risk in that, right? So it's unfortunately not cookie cutter, at least according to us. But if I have to talk about by and large, yes, more or less everyone falls into the 60-40, 70-30, but not because that's the norm, but it should be an inherent bottom-up approach as to where equity, debt, gold, real estate, jewelry, international funds, international tech, US funds, etc., all play a part.
Sure. We have the next question from Mr. Anurag Dave. Hi, Anurag. Okay, I'll just ask, what kind of strategy should a government retired person follow? Main focus is less risky investments. So a broader answer would be fine here.
Sure. I think it's very simple. For any retiree, safety is the primary concern. I don't even want to go into consistency per se. Assuming that this person does not have any taxable income, most mutual funds would not be able to provide as much as an FD with the risk a FD provides. So I would suggest either go into the top 2-3 government banks like an SBI bank, maybe in a private bank like an HDFC bank, make an FD which is there. And obviously, if there is a certain amount of money, and I would not encourage this to be the larger chunk of investments, you can always play around with a few mutual funds, a few debt funds, etc. But by and large, an FD, just because it is tax efficient, because that gentleman is not a tax-paying entity.
Understood. We have a question from Gauri Ketkar. So you mentioned about booking your losses. So the question was, since holding period matters, when do you take the call to stop waiting for profits, and when do you actually book the loss?
When your thesis, if you remember, let me try and go back to those 3 points. Right, the optimistic India story, your asset allocation, and your fund selection. Right, as soon as you start thinking that the India story is going wrong, right, from a longer term perspective, you should reduce your equity allocation. As soon as you think, and if I had to give an example on asset allocation, saying that, look, there was a client of mine who had a decent high allocation of 80%, right? 6 weeks back, he lost his job, right? The first call he made was to me saying, Jai, we need to bring down our equity allocation. I don't care what the loss is. I don't care what it is. Startups are not going to do great now. I don't know whether I'll be able to find a job or not. I need to get down my asset allocation. And the third thing is the fund selection, right? When I say fund selection, are all these criterias in question, right? Has the fund managers changed? Has the performance matrix that you are judging on, has that degraded? Has it become that the investment team is seeing a lot of churn? Is this fund manager managing a lot of funds? And the question that was asked effectively on stocks per se is very simple. Is effectively, and this came across very recently. Whenever you're thinking of a stock, instead of marking your stock price to a P&L, mark to market your thoughts or the original thought process rather than the P&L. And as soon as they combine, and they always have to converge, right? So if your thought process remains the same, there is no reason for you to sell the stock. If your thought or your original concept of that stock saying that, look, it should grow at 20%, if that starts to come into question, then start marking that thought and saying that, look, now I need to discount this stock a little bit. If completely from profit they've gone into a loss, ask those questions why they've gone into a loss. And these answers are fairly simple, right? There doesn't need, at least to answer whether I should exit a stock, is relatively simple. The hypothesis has completely gone bust. It's as simple as that.
Yeah. Jai, we'll just take the last 2 questions.
Sure.
We have one question from Mr. Puneet Makkad. Hi, Puneet. Can you please ask your question?
Jay, hi, how are you? Thanks for the event. Very good insights. I actually had 2 questions. One was regarding the current moratorium being offered by the government on loans. Not sure if this is in your scope today, but what's your view? Do those of us who can even continue paying the EMI, should we take the moratorium or should we not?
See, I think it's a simple, if you guys are stressed, if cash flows are an issue, definitely, right? Without any doubt. But if cash flows are not an issue, you're just kicking the can down the road without any added benefit, right? So if the question is, should I be paying by credit cards? Absolutely. If you can afford it right now, 3 months, something drastically is not going to change in my mind, at least with most people.
No, question not about credit cards, really about the term loans, which might be at sub 10%. Given the opportunity, let's say I had to trade off between keeping a large investment in the markets today versus paying off a loan which is sub 10%.
Oh, absolutely. Without a doubt, I would not encourage you to do that arbitrage.
Sure.
No matter, see, the entire idea of high volatility, no matter what you're thinking right now, is from the longer term, yes, there seems to be a good opportunity to invest right now. Is it a great opportunity for the shorter term? I would be very wary of that because there's still a good amount of uncertainty, right? I don't know when the vaccine will come. I don't know if there's some medical intersection that will happen. Who knows these things? And even that, I think the point that people are missing out on, even before pre-COVID, right? There were enough issues in the Indian markets to say that, look, maybe in the shorter term, things are still not hunky-dory,
Sure.
right? So I would strongly be against something or trying to optimize or trade the markets for a certain amount of EMI that needs to be paid.
Okay. Thanks for that, Jay.
Sure, I hear you. So you're not very, very bullish in the short term. Thanks.
No. So Puneet, it's not a question of being bullish or bearish. It's a question of uncertainty.
Got it.
I
We
hear
take
you. Sure.
questions
Sure.
from.
Thank you.
We take the last question from Mr. Anshul. Hi, Anshul. Can you please unmute yourself?
Yeah. Hi, Jay.
Hi, Anshul.
Can you suggest something, for a few HNIs, what should the asset allocation should look like? I mean, as your money grows, how do you keep on diversifying and what all different asset class you can look into with larger set of money? And also along with that, can you talk about or give us some tips on angel investing? How early one should look into this and all those things.
Absolutely. So the first question, Anshul, is very simple. If you're only in mutual funds, a PMS has a limit of 50 lakhs per investment. And AIF has a limit of 1 crore per investment. There are multiple options on PMSs, on AIFs, on structured products, on PEVC funds that you can explore. Almost all these funds are regulated by SEBI. But very important to understand that what they are doing, how they can actually diversify for your portfolio or for your wealth, and whether it actually adds any benefit, right? Sometimes we've seen a lot of clients just go into different products for the sake of diversification, right? Without actually understanding the risk. Now, to give one example, the structured product that we talked about, right, which is saying a capital guarantee as well as a multiple on the upper side, right? Now, it's very easy to say that, look, Jay, this sounds like a winner to me. But currently, a lot of the people who have given these or manufactured these structured products are under a lot of stress. Some of these NBFCs, maybe like an Edelweiss, right? And hence, when you initially took this trade, I'm not saying it's a bad product, right? But it's very important to understand the risk and allocate accordingly. But to answer your question bluntly, Anshul, everything should be open. You should be doing some amount of direct equity through a good advisor, some amount of these products through a good advisor if you don't have the capacity to do it on your own, and then continuously try and get that knowledge that how are these different products which are continuously coming into the market, can they add value? Because new products will continue to come. Some of them will make sense. Some of them are just to garner AUM and will be forgotten. It's very important to differentiate those products from what is important to you.
Right.
Basically, you're saying that we should invest in stuff which we understand, right? End of the day.
100%.
Right. So something like Bitcoin, if I don't understand, I don't get it, should stay away.
Yeah, and this comes up, and this is exactly what the greed is, right?
Yeah.
Where we're saying that, look, don't, everyone is, let's say 10 people around you are talking Bitcoin, 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 Bitcoin. It'll be very unlikely for you to not invest in Bitcoin then. But put in that amount where you're comfortable saying that, look, even if I lose this amount, I honestly don't care.
And lastly, on the tips on angel investing, if you can.
So what I would say is, if you've not been doing this for some time, Anshul, I would say get associated with one of these companies, right? Either Bombay Angels, there is the India Angels, etc. Where what generally happens, and it's a great way to learn, you will get to know where the 3-4 marquee investors are investing, right? And then you can try and assess why they're investing in what they're investing. If you have to try and do this from the get-go, I would not recommend it, right? Because there are a billion ideas to deal with, right? There are a lot of hidden agendas. There are a lot of hidden risks which are there. In fact, I'll give you an example, and this came across to me very starkly. We talk about valuations, etc., right? That this valuation went from 100 to 200 to 300 to 400. More often than not, a lot of the times when someone makes an investment is actually through a preferred share, right? And that preferred share actually balances out the valuation. So let's say if I'm a startup, I said that, look, I want to get valued at $100 million. He says, sure, I'll put in this, $1 million at the $100 million valuation. But on the remaining $10 million that I put in, I want a 20% interest rate. Right? So the IRR for the person putting in the money is already 20%. And so when it actually boggles my mind sometimes, like a SoftBank guy, sure, he made a loss, right? Who's there. But most people invest through a preferred rate, which already has an IRR on that, gets converted maybe 3, 4, 5 years later, and then might give you the equity pop.
Sure.
Right? The small things which get missed out by people, again, who are not into this. And coming back to the same point that you made, Anshul, it's better to get associated with someone who knows something, maybe learn from them, and then try and do it on your own.
Sure. Thanks, Jay.
So Jai, that was it. Thank you so much for taking out time to take out this session and just give us so much knowledge. Thank you to all the participants for attending. We can end this session now. Thanks a lot, Jai.